ABSA's Kenyan subsidiary has reported a 27% rise in net profits for the 2024 fiscal year to $151.8 million, and that's despite a near 8% contraction in its loan portfolio. Now, the total loan book declined in nominal terms, in fact, every single quarter of the year, to stand at $2.39 billion in December, mirroring broader trends within the industry. Combined holdings of government debt rose aggressively, especially in the second half of the year to end 2024, 37% higher at just over $1 billion. Interest and non-interest income rose by double digits, but so did the stock of non-performing loans. It stood at nearly $330 million. Now, the bank's non-performing loan ratio stood at 13.7%. That's lower than the industry average, but it does represent a 300 basis points increase in the course of the year. Earlier today, I spoke to the Chief Financial Officer at ABSA's Kenyan unit, Yusuf Omari. I started our conversation by asking him, what was the biggest driver of the contraction in the loan book? A stronger local currency or significantly weaker demand for debt?
We have about 32% of our loans and advances being in foreign currency. And so the minute the local currency strengthens, then you actually see a shrinkage of that book without impacting the volume as such. But then the bigger component of it, if you're looking at it quarter on quarter, it's because of what we've seen: high interest rates in the year consistently until towards the end of Q4 when the interest rates came down, and then of course the impact on the macroeconomic environment, the tax measures, increasing taxes to the business and of course to individuals, which basically has meant that the private sector has stayed away from long-term borrowing. So, and in the entire industry, if you look at it in November, a drop in lending year on year of about 1.1%. So it's a general trend that we are seeing because of what I've explained.
Indeed. And even with this reduction that we're now seeing in lending rates, the central bank has been cutting rates, we're seeing banks reducing the lending rates. But combined, if you look at the demand side of the picture, right, disposable income has been in decline. We're still weaker than where we were pre-pandemic. And of course, with the tax policies that you mentioned, taking a bigger chunk out of what is left, and it's fairly adversarial, at least from the perspective of households and businesses, isn't it reasonable to expect that the loan book will continue to contract in fiscal 25?
I think in the short term, you won't see a massive change in terms of uptake in loans. For the points you've mentioned, still there's an element of addressing the disposable income. We've sorted one component of it, which is the cost of these facilities. Rates indeed have come down, the entire industry, all the banks, ourselves, we dropped rates by about 350 basis points. That's one side of it. But then there's a bit of disposable income that needs to come through. So it will take time for us to see that uplift in loans and advances.
Let's talk about the government securities on the books, because looking at the trends, especially in the second half of the year, there was this big surge right into government debt. If you essentially just tot up all that's being held on ABSA's books at the moment, what explains that drive into government securities?
I think one, and this one I'm looking at it in Q3 last year, of course, is the attractive rates. And again, I would say this happened across the entire industry. At that point in time, a one-year T-bill, you're getting as high as 16%, kind of rate. So quite attractive. So that would be one comment I'll put there. I think the second one is really the opportunity to invest. So we grew our deposits. If the customers are not borrowing, then the options in the industry were, of course, to invest in government paper, and that is exactly what happened in that period.
I'm looking at it from a slightly wider perspective, looking into 2025, right? We're in a situation where consumer demand is expected to be relatively subdued because of the factors we've spoken about: weaker disposable income for one, higher taxes on the other as well. Kenya's essentially come off an IMF program, so our deficit situation is likely to be a bit more elevated, at least in the short run. Will you maintain this aggressive push into government securities, even though rates on those have now come down by at least 600 basis points?
Yeah, I think in the short term, you will still see an interest in government security. If you look at the latest auctions, two of them in the month of March, there's been a significant oversubscription. One was over 200%, the other one was around 180% oversubscription. So in the short term, still you'll see an interest in government paper, and for right reasons, because again, you don't expect a significant jump in uptake of loans within a very short time. But as we move into the medium term, you start seeing preference on government, on customer loans, as opposed to investing in government security. And remember, Rama, that is actually an objective for the government. The government wants to, last year, we crowded out the private sector. This year, the government has come up with all the incentives. Monetary policies are working. We've seen a drop in rates. The government has also gone ahead and even dropped the CRR ratio.
But if and this always comes back to the original question, right, that we always ask when we have these conversations, there might be excess liquidity on one end of, on the supply side, but the demand side is still pretty weak, right? So, other than the short-term debt that we've spoken about, are there really places where that capital can be deployed, where there's growing pockets of demand? I mean, I know you've spoken about the custodial business as the new kid on the block and one part of the business that you really want to grow, but I mean, I'm struggling to see where the demand for new liquidity would be.
Yeah, no, I think it will be a slow burn. I think that is for sure. So all the measures have been taken. We are finding ourselves with very healthy liquidity ratios. If you look at it across the entire industry, certainly if you look at our results today, very, very healthy liquidity ratio. It will take time.